Here is a number that should make every European pay attention. By the end of 2026, Italy's public debt is forecast to climb to roughly 138.6% of its entire economy, up from 137.1% in 2025. That single shift means Italy is set to overtake Greece as the most indebted nation in the entire Eurozone. We are talking about a debt pile worth around 3 trillion euros, the third largest economy in the bloc, carrying a fiscal weight that dwarfs almost every neighbor. But here is the part most people miss. Italy's finances are not an isolated national story. They are stitched directly into the machinery of the European Union, the shared euro currency, and the rules set in Brussels and Frankfurt. In this video, we will break down Italy's 2026 financial update and show you exactly how every figure connects back to the EU. To understand the connection, you first need the context. Italy is a founding member of the European Union, having signed the Treaty of Rome back in 1957. It is also a core member of the Eurozone, the group of 20 countries that share the euro as their currency. This matters enormously. When Italy joined the euro, it gave up control of its own monetary policy. It can no longer print its own currency or set its own interest rates to manage a crisis. Those powers now sit with the European Central Bank in Frankfurt, which sets a single interest rate for the whole bloc. So when Italy borrows money, it borrows in euros, under rules it agreed with its EU partners. This is the foundation of the connection. Italy's economic decisions ripple outward to the other 19 euro members, and their decisions ripple straight back into Rome. Let's get specific with the latest figures. Italy's budget deficit, the gap between what the government spends and what it earns, is projected to fall to around 2.8% of GDP in 2026, down from 3.1% in 2025, and forecasters expect it to slide further to roughly 2.6% in 2027. That falling deficit is genuinely good news and shows real fiscal discipline. The problem is growth. The European Commission expects the Italian economy to expand by just 0.5% in 2026, one of the weakest rates in the bloc. When an economy barely grows but already carries enormous debt, that debt ratio becomes very hard to bring down. It is a delicate balancing act. Cut spending too hard, and you choke off the little growth you have. Spend too freely, and you breach the rules you signed up to in Brussels. This is where the EU connection becomes a hard legal reality. Every Eurozone member is bound by the Stability and Growth Pact, the EU's fiscal rulebook. Two numbers sit at its heart. Your annual deficit should stay below 3% of GDP, and your total debt should ideally stay under 60% of GDP. Italy is comfortably over the debt threshold and has been pushing against the deficit limit. When a country breaks these rules, Brussels can open what is called the excessive deficit procedure, a formal disciplinary process that requires the country to submit a credible plan to fix its finances. Italy has been under exactly this procedure. The encouraging news for 2026 is that by pulling its deficit below the 3% line, Italy has a real chance to exit that procedure this year, provided the European Commission is convinced the improvement is permanent rather than temporary. So why does the rest of Europe care so deeply about Italy's books? Because of the shared currency and shared risk. When investors worry about Italy's ability to repay its debt, they demand a higher interest rate to lend to the Italian government. The gap between what Italy pays to borrow and what safer Germany pays is known as the spread, and it is watched obsessively by markets across Europe. A widening spread signals stress. Because all these economies share the euro, trouble in Italy can quickly spread fear to Spain, Portugal, and beyond, threatening the stability of the entire single currency. This is precisely why the European Central Bank has tools designed to step in and buy government bonds if a member faces unjustified market pressure. Italy is, quite literally, too big to fail within the Eurozone, and that shared fate binds it tightly to Brussels. The connection is not only about rules and risk. It is also about money flowing in. After the pandemic, the EU launched its landmark recovery program, NextGenerationEU, and Italy is by far the single largest beneficiary. Rome was allocated close to €195 billion in grants and low-interest loans through the Recovery and Resilience Facility. That is a colossal injection, funding everything from high-speed rail and digital infrastructure to green energy projects across the country. But this money comes with strings firmly attached. To unlock each installment, Italy must hit specific reform targets and investment milestones agreed with the European Commission. If reforms stall, the payments can be delayed. So a huge slice of Italy's investment and modernization plans for 2026 depends directly on satisfying Brussels. It is a powerful example of how deeply Italian and European finances are now intertwined. Let's look at how Italy is actually trying to meet these commitments. The Italian Parliament has approved its 2026 budget, built around deficit-cutting measures designed to bring the country in line with EU demands. The government, led by Prime Minister Giorgia Meloni, has prioritized fiscal discipline to keep the deficit on its downward path. Crucially, the Eurogroup, the gathering of Eurozone finance ministers, assessed Italy's draft budgetary plan and judged it compliant for 2026. That stamp of approval matters, because it signals to markets and to Brussels that Italy is playing by the rules. The strategy is clear. Keep the deficit falling, prove the improvement is durable, exit the excessive deficit procedure, and start the slow grind of stabilizing that enormous debt ratio before it begins a gradual decline later in the decade. Whether weak growth allows that plan to hold is the central question. So what is the big lesson here? Italy's financial update is, in every meaningful sense, a European story. Its debt heading towards 138.6% of GDP is not just a domestic statistic. It is monitored by Brussels, it shapes the European Central Bank's thinking in Frankfurt, and it influences borrowing costs from Madrid to Berlin. The EU connection works in both directions. Brussels imposes the fiscal rules and the disciplinary procedures, yet it also delivers nearly €195 billion in recovery funds to help Italy modernize. Italy, for its part, is simply too large to be allowed to stumble. As we move through 2026, the key things to watch are whether Italy formally exits the excessive deficit procedure, whether its bond spreads stay calm, and whether that sluggish growth picks up. Because in today's Eurozone, when you study Italy's finances, you are really studying the health of Europe itself.